Good morning, everyone. Thank you for coming to my webinar on how to know when it's time to sell your business. This is kind of the first time I'm using this webinar platform through Teams, so I'm not entirely sure how it's all going to work. So please be patient with me in the mechanics of it. I know that we have the chat in the Q&A. And so feel free to put things in the chat or in the Q&A, and I will do my best to watch for that. And we'll take it from here. And of course, we are recording, and everybody's going to get a recording when we're done. And I also have some bonus materials to share with you that I hope you're going to like. All right, so let's begin. Today, we're talking about how to know when it's time to sell your business. So we're gonna dive into that topic of selling your business, and we're going to explore the signs that indicate it might be time to sell, and how to prepare your business for the sale, and the steps to ensure that you're going to get the best value when you do go to sell. And if you're here to learn about those things, then you are in the right place. And I want to make sure you guys can all see my screen. Is that right? You can see my screen and you can see me. Could somebody in the chat give me a thumbs up on that? Thanks, Robin. I appreciate that. Like I said, this is the first time I'm doing a webinar in Teams, and it is a little bit different than Zoom. And so we're just gonna fly from here. Okay. My name is Kimberly Hanlon. I am one of the founding attorneys of Lucere Legal. We are a Twin Cities-based law firm that serves entrepreneurs and their families in the areas of business law, estate and probate, and real estate, and that's all we do. One of the things that we do in the category of business law is we help people buy and sell businesses in all sorts of ways. I'm also the author of the Minnesota Small Business Owners Legal Survival Guide, which is a plain English guide that gives business owners the things that they need to know on the legal aspects of running their business, but in plain English. And of course, a lawyer would have a disclaimer, and here is mine. This presentation is for educational purposes, and that is to say, while I am a lawyer, today I am not your lawyer. And I'm not talking to you about your specific situation or doing such a deep dive that I can give you salient legal advice as far as your situation is concerned. And so feel free to put anything you want in the chat or the Q&A. Hopefully I can figure out how to make that work. And I'm glad to answer your questions. But remember that we're talking in broad strokes today. And there's no attorney-client relationship that's being formed here. So anything you do put in the Q&A or the chat as part of this workshop is not covered by attorney-client privilege. All right, now my malpractice insurer is happy. Now we can move forward. All right, so there are several signs that suggest when it might be time to sell your business. So some of these include market conditions, personal circumstances, and even the business's performance. So we're going to talk about each of those in a little more detail so that they can help you make an informed decision about when you might be ready to sell. Did I skip one? No. Okay. So one sign that it may be ready to sell is market conditions. And market conditions can present in several ways. The first one is an economic downturn or recession. So when the broader economy is slowing down or entering into a recession, a business owner might anticipate that they're going to have declining revenues or maybe increased operational costs. Or sometimes, if they're kind of on the cusp, do I still want to I'm not sure if I still want to continue on in this business. Do they want to do kind of like that hard work that it takes to make a business succeed through, a downturn period? So for some people, when they see those economic, conditions making a turn, selling before that downturn deepens really can help preserve the business's value and, avoid future financial strain and also, future personal strain if they don't really feel like they have the longevity to make it through. So here's where you may see shifts in like the local economic indicators. The Minnesota Secretary of State has an economic and business condition report, and that gives regional trends for Minnesota businesses, such as declining job vacancies, slowing business formation, and weakening consumer demand, and all those sort of things can like signal when something, the economy might be making a turn. So you can look at those reports and sort of look for yourself what's going on. Also, there's periodic, the jobs report that for nationwide that comes out is something that you can look at. And also talking to other, business professionals can help you, figure out whether it's a good time to sell, if they think that economic conditions are worsening. Um, and then you also, another way that you may see it is with real estate, the commercial real estate market is tied very, very closely to the overall business market, especially for businesses that are tied to physical locations like a doctor's office or like a retail store or a restaurant. When commercial lease rates rise, or there's a lot of changes in property tax assessments, all those sort of things can be tipping points that either will make the business workable or not workable. And so sometimes, when those sort of conditions are shifting, a lot of times that's when business owners are looking at that kind of that cost benefit or that pro and con. Do we want to sell, while we can, are we constrained in a high cost area? Is it better for us to sell our business rather than, renegotiate our lease or relocate? What makes the most sense, given these situations? So another market condition is industry consolidation or increased competition. So when sometimes there's cycles where larger competitors begin like acquiring up all the smaller firms and consolidating into kind of larger firms. And then it makes it harder for new people to come in to the market. It also sometimes makes it harder for existing people who have been around for a long time to be able to continue to compete with these larger and larger competitors. Also, sometimes we have new people who come into the market and really, really change the landscape. Sometimes, there are like market disruptors, you could say, people who have an innovative new model. And when those things are happening, sometimes business owners can see, oh, this is starting to happen. Maybe it's a good time to sell while our company still holds value, you know, as opposed to holding on to it and seeing that value be eaten away by what's happening in the larger market. And then another market condition that is kind of in a way the other end of the spectrum is when there are favorable market valuations. So in a seller's market where demand for businesses is high and the valuations are strong, that's a good time for owners to decide to sell while they want to capitalize on premium offers. So, this is especially common during times when interest rates are low and investors are like really actively seeking acquisitions. But another, aspect for when people want to uh, think about selling their business is personal circumstances. And actually, personal circumstances, a variety of personal circumstances, is oftentimes, the reason that our clients decide to sell. Um, and just like market conditions, personal circumstances come in a few varieties. So one of the big ones is, retirement. Sometimes, business owners been in business for a long time and they're like ready to do something else. Um, a lot of times people see selling their business as kind of like the culmination of the decades of work that they've put in. And, a lot of times by that point they have financial stability and they're ready. And, especially in places like Minnesota, I mean, we all know that like lake life, cabin life is a thing here, and so is snowbirding. Um, you know, Minnesotans have a strong desire to have a work-life balance, and you know, people in Minnesota are often also community oriented and want to think in terms of volunteering. And there's a lot of things that Minnesotans want to do with their lives in addition to or instead of spending time in their business. So, we see this often, and we work with our clients to have sort of a holistic sales strategy that includes tax planning and that works seamlessly in their estate plans and make sure that they're able to do the things that they want to do um, post sale with their lives. And just on a side note, not everybody stays retired well. We certainly see plenty of people who sell their business, they retire, and they find that um, their time being retired is not as fun and interesting as they thought it would be. And then they look for what's next and new. So that happens too. But there's nothing wrong with like setting down, the business here and then picking up something else later. And then of course there's burnout, and that can happen that can happen even early on in a business's evolution. you know Sometimes people just really need a lifestyle change. Running a business can be emotionally and physically taxing. And like I was saying before, in Minnesota, culturally, we really do have an idea of work-life balance, where these other aspects of our lives are also highly valued, and so burnout can be a common reason for selling. People, maybe they want to travel, maybe they want to spend more time with their families. Things like that can prompt people to sell their business. And we've had clients where their personal well-being and their mental health really influence their decision to sell. And then, of course, there's people who have unexpected health concerns, and that's either personal or sometimes it's within the family. And unfortunately, that can force a business owner to sell sooner than maybe they had planned, and these situations are often really sensitive. Unfortunately, they're not all that uncommon though. And when we see these situations and the owner hasn't done any, advanced planning and doesn't hasn't done any of the things that make a business valuable and saleable, and often those situations don't end well. Which leads me to my next talking point, which is preparation is key. Preparation is key to a successful business sale. So we're going to cover the essential steps, like such as organizing your financial records and improving your operations and enhancing your business's appeal to potential buyers. Because really, that's kind of what it's all about at the end of the day, is having your business be positioned well for the sale. So the first aspect of preparation is with the business's financial records. And of course, I mean, that's pretty obvious to people. But sometimes people don't always know exactly what does that entail or what does that mean. So the first thing is to make sure that the business has clean and reconciled financial statements. Now, let me say a bit about what I mean by clean financial records. I mean, of course, I would hope that everybody on this webinar or people who are going to watch this recording later, of course, I hope that you are running your business the way that you should, keeping track of your financials. But clean financials means more than just, like, are you keeping on top of your bookkeeping? So consider that as business owners, we often have the ability to run certain expenses through our business that make it possible that we ourselves are minimized on our personal income tax, right? But when it comes time to sell your business, you don't want a lot of like those sort of personal, they're not always personal, but let's call them quasi personal, right? You don't want a lot of those on the books. They make it more tricky to do, like the add backs and offsets and things like that. It makes it harder to get a clean value on the business. And when it comes down to it, the people who are wanting to buy your business are wanting to know, like, really, what's in it? What's the potential in it for me? So when you are preparing, the I would say like 3 to 5 years, generally at least 3 years of, leading up to your sale, it is better for you let your CPA know, you know what, I want to be preparing my business for sale. I want to, instead of minimizing my personal tax, I want to maximize the bottom line dollar in my business so that it looks the best it can for potential buyers. And it also just makes it easier to value. You have less of your own personal stuff in there. So when we're talking about clean financial records, we're talking about, the income statement, the balance sheet, the cash flow statement, that they're accurate, they're up to date, they're reconciled with your banking credit cards, and it doesn't have your personal expenses in your business accounts, and you've corrected any misclassified transactions, and you have consistency in how you're handling your accounting, and I mean that like in a broader way than just like whether you're doing accrual or cash. I mean, obviously that is important to be consistent, but from one period to the next, how you're handling those expenses. Um, buyers and their professionals are going to scrutinize, your financial documents. And a lot of what they look at is to try to figure out what is the real business's financial health, what is its risk profile. So one of the business brokers that I like to work with is Young Beavis, and one of the things that she always says is there's an inverse risk between your business's value and its risk. So if there's stuff in your books that looks like, your business might be risky, that value is going down. So there you go. Have clean financials. When you're preparing for a sale, it's important to maximize gross profits and not just minimize taxes. Like I had said before, I jumped ahead of myself, you could say. Minimizing taxes is a common goal during operations and when the business is growing. But preparing for a sale, it's more beneficial to show strong gross profits. And there's other ways in addition to, controlling your expenses to make that work. You can review your pricing strategies, and sometimes even just a small bump in price, a lot of times your customers will continue to do business with you. There's enough desire in the market for you to be able to do that bump in price, but it really can add to your bottom line, especially when your operating expenses or your cost of goods sold isn't increasing. And of course, if you can reduce the cost of goods sold, even better. And so sometimes you can do that with vendor negotiations. Sometimes you can do that with operational efficiencies, like smoothing out your processes of how you do things, or sometimes automation. Of course, AI is going to help so much with that. Already is helping with that in so many ways. And also you can really do a push to increase your sales of your high margin products and services, as opposed to a lot of doing a lot of work on low margin products or services. So one of the things you're going to need to know, of course, are what are my margins on each of my products or services, so you know what you want to really focus on your marketing and sales. And then, of course, there you foregoing certain business expenses that you and only you benefit from. And, all of this matters because, a higher gross profit margin like signals to buyers that it's a strong operation, there's possibly scalability, um, that it has a stable foundation, and all of those things increase the business's valuation. And that's all part of what this whole game is about. All right, so the next thing is to organize your supporting documentation. So we're talking about organizing and gathering at least the last 3 years of tax returns, payroll records, loan agreements, and debt schedules. If you have inventory, your list of inventory, if you have hard assets, the list of those assets, and your contracts. Believe it or not, your contracts are contracts that you have with vendors, contracts you have with clients. Those are all items of value. They are often assets. Sometimes they look like liabilities, but they're also assets of your business in that they give you certain rights. So when you have all of these documents in order, it provides like transparency to the potential buyer. It builds confidence, like what they know what they're going to get, and it really speeds up due diligence by having all those things already organized. All right, so the next aspect of preparing for a business sale is improving business operations. When you improve business operations, you're increasing the business's value through efficiency. So streamlining operations, like automating workflows and reducing waste, or like optimizing your staffing, all of those things can significantly improve your profit margins and your cash flow. And of course, all of that is part of what business buyers are looking for. Business buyers are drawn to businesses that can run smoothly and that require minimal intervention. Very rarely do business owners or business buyers want to buy a business that they have to like step in and more or less run or rebuild. It's more often that buyers want to buy a business that can run itself with some oversight from the new owner, but not that they want to step in and actually have that business as like a job. So, the more your business runs efficiently, without intervention from the owner, the better. Also, businesses that have systems and processes in place, are perceived as less risky. And of course, less risky means higher valuation. And efficient businesses also that have systems and processes also demonstrate scalability and transferability. So when you have well-documented and efficient operations, and you can show that the business can grow without being overly dependent on the owner, that's exactly what most business buyers are looking for. So we're looking at your business having things like standard operating procedures and clear roles and responsibilities, and reliable systems for things like counting your inventory or keeping track of your inventory, billing, and like customer service. So it's not like every time a situation happens that you have, there's a fire and we have to figure out how to deal with the fire. It's like, no, we have a normal way of working through, all the aspects of our business, and we know what we're doing and how it works, and anybody else can also step in and see what we do and how it works. This makes a business more attractive, for the buyers who want to step in and scale. And then improving operations also improves your financial clarity and your performance metrics. For most people who decide that they're going to prepare their business for a sale and they start putting in place all these pieces, their business gets easier to run and less stressful for the owners. And people say, oh, sometimes I've heard people say this where it's like, oh, well, now that I'm getting my business, ready for sale, I'm really enjoying working it now that it's way less stressful than it was before. It's almost like how people, when they want to go prepare their house to go on the market, and they paint everything and they fix everything, and everything is like so clean and beautiful, and they're like, wow, I really like my house now. Do I still want to sell it? Anyway, that happens, and it's like it helps with your sale, and it's also a nice side effect. So operational improvements, they can lead to cleaner financials and more consistent performance metrics, and reduces your pain points, or like your operational bottlenecks, right? Which also improves your profit margin. It can sometimes, have you have better vendor management, and which means like you can have, like you can demonstrate, oh, okay, well, here's my metrics, and hey, supplier, hey, main supplier, you know, let's negotiate a better deal because I can demonstrate, that I can demonstrate my value to you as a customer, things like that. Um, Efficient scheduling and service delivery. I mean, I know some of you on this webinar are service providers, and dialing in um, that customer service and being there fast, and having the product when you need it, and being able to serve people, at the point of their highest need, makes a huge difference in your business's growth, its scalability, and its value. So these improvements, they not only boost profitability, but they make the business just overall holistically better, and they also make the business easier to evaluate during due diligence when you have, all these things, these metrics that you can show people. All right, so you may be wondering, what can you do to improve your operations? So I put together some bonus material, or sort of like an implementation guide that I'm giving today. And I put in there a list of action items that you can take to help improve your operations, some of which are low cost, high impact, that you can start implementing today. And actually, let me take a moment to put that in the chat. I will also send it in the email afterwards, but I think that I can, if you'll just give me a moment, I think that I can. Mm, no, it will not let me. I thought that I would let me add it to the chat, but I don't see that it does. So I'm sorry about that. Um, all right. Well, we're evaluating whether Teams is a good platform for a webinar, and now we'll know that's another thing. Anyway, I have this great guide for you. It has all sorts of information. Preview coming attractions. Okay, so the next way to prepare for a sale is enhancing your business's appeal to potential buyers. And of course, that makes sense, right? It's kind of like putting the fresh coat of paint on your house before you put it on the market. It's about making your business more attractive, less risky, and, an easier yes for a potential buyer. So here are some effective ways to do that. The first one is to reduce the business's dependency on you. and why that matters. Buyers want a business that can run smoothly without you, right? But they also don't want to step into your shoes, right? They want to buy an asset, they don't want to buy a job. So how do you reduce your business's dependency on you? Well, you learn to delegate key responsibilities. You make sure you cross-train your staff and that you have documented workflows and, systems and processes for decision making and things like that. You should be the face of your business, but that doesn't mean that the business needs to always be dependent on you to decide every aspect of it. So, you know, also you can start transitioning client relationships to other team members. It doesn't always have to be you because you know, you have great people working for you. Let them step in and also have those relationships. When your clients or customers are loyal to not just you, but your other team members and your overall business and your overall brand, that's very valuable to a potential buyer. The next thing is to have recurring revenue and sometimes even client contracts, like clients who are locked in, right? Predictable income is what this is about. Predictable income streams. So when a business has uh, like subscription models or clients that are under service contracts for a certain amount of time, that reduces the risk as far as potential buyers are concerned. And of course, that increases valuation. So look at doing long-term contracts or subscriptions. Like how can you work a subscription into your current business model? Retainer agreements, things like that, service clubs, things like that, and ensure that the contracts that you have are transferable and clearly documented because assignability is a deal. So next is polishing the brand. And you could say polishing the customer experience. A strong brand is one of the things that buyers like to buy, right? And a loyal customer base. If your business is just a commodity and like one could, like your business could be, swapped out for any other business, then it really has less value than when you have something special that people go to you because you have something special. So here's some ways that you can polish up your brand. Time to refresh your website, improve online reviews, get online reviews. So many people, myself included, aren't always great at saying, hey, happy customer, would you leave me a review? And streamline your customer service experience because people don't just go to your business for whatever it is, your product or your service. They also go to your business for the experience that they have dealing with you and your staff. And so you want to make that the best it can be. So even small improvements in branding and that client experience and client communication can make a really big difference in perceived value. So next, we're going to talk about how businesses are valued. So like understanding how your business is valued is really crucial. So we're going to explore some of the different valuation methods, and I'm going to share some tips on how to maximize your business's value. But I am going to say this, I am not a business valuation expert, and I refer that out to other professionals. So what I'm going to give you is just kind of going to be a very quick and dirty overview. But if you do have any desire to know what your business is worth, I will be super happy to give you a referral to the people I recommend. And I would also say this about business valuation, that most business owners really have no accurate idea of what their business is really worth. I have had clients who had, you know, they were so far off in the ballpark of what their business was worth on both sides. I've had people who assumed that their business wasn't worth that much, and it really was. And I've also had people who assumed that their business was worth a lot, and it really wasn't, And so if you're in this inquiry, I encourage you to get a business valuation. And also, I want you to know there's different levels of business valuations. What I mean by that is there's this kind of like top level, which is like a certified business appraisal that we as attorneys get when we're in a litigation case, or if there are some reasons why you would need that very top level, but there is also what you could get, what is I would say equivalent to a broker's price opinion, which is not to that level that we would use as evidentiary, but is still accurate and a good gauge for you and for what your business is worth. And if you're considering a sale or preparing for a sale, I encourage you to go and explore that. Okay, I'll get off my soapbox now. So let's go through the different methods that are used to value businesses. And don't worry, I'm not going to get technical, and we are not going to do any math. So the first way that valuation method is an asset-based valuation. So what this is a method that looks like what is it that the business owns, and then subtracts what does it owe, the liabilities. So this is good for businesses that have lots of tangible assets like equipment or inventory or real estate. So think of it this way. What would it cost to rebuild this business from scratch? That's sort of that asset-based valuation approach. The next is a market-based valuation. So what this is where we compare your business to other similar businesses that have recently sold. Now, a lot of times for closely held companies, there isn't any data out there, or there's very little data out there for what similar businesses have recently sold. There's some, but this is usually like one particular factor that we look at, but at least in the types of clients that I generally have, this isn't the method that people are leaning heavily on. So this is really best for businesses and industries with lots of comparable sales data. So think of it like this: what are similar businesses selling for in today's market? Okay, next is the income-based valuation. And you might have also heard of this called discounted cash flow method. So this method estimates the future profits of the business and then calculates what those future profits are worth today. And that's where you get that discounted cash flow, because it's like a discounted future value, right? So this is a good method for businesses that have, stable and predictable earnings. So think of it as, what is the future income of this business worth right now? So then there's another method called seller's discretionary earnings. And this is where one of the ways that you hear the term multiple come in. So this is the method that starts with the business's, profit, and then it adds back, those owner perks, like I was talking about before, like the owner salary and like travel and those kind of quasi personal expenses, right? To show true earnings. And then we apply a multiple based on like the industry norms. So based on what is the size of this business, and what is the multiple for that is usually traded for that type of business in its industry, things like that. So this is really best for the small and medium-sized owner-operated businesses this valuation method is what comes into play most with my clients. And so I want you to think of it this way. What's the real earning power of this business for a new owner? And so this is, um, I'm thinking that a lot of people on this webinar or that might be watching this later, this might be the valuation method that is going to be maybe most useful for you, but of course it's hard to say. And I don't do that work. So, and then you've probably heard of EBITDA, earnings before interest, taxes, depreciation, and amortization. This also has a multiple. So it's similar to the prior one, but this is more common for for larger businesses. So this focuses on that operational profitability. Um, and it's, mostly used for medium to larger businesses and a lot of times for people who have outside investors. So the thing to think of this is, how profitable is this business at its core? So that's how businesses are valued. Next, I'm going to give you some tips on how to maximize your business's value, because that's really what it's all about. No matter what method your business falls in, that makes the right way to value your particular business. It's all about maximizing your business's value. So I have 5 strategies that's designed to help you position your companies as attractive, high value opportunities, and I always want to look for low cost, high impact. So things that don't require a large investment. It's one thing to say, oh, this is what you need to do to make your business valuable, but if it's cost prohibitive, what good does that do? So the first thing is to systematize and delegate. So a business that can operate smoothly without the owner, like I've said before, is more appealing to buyers. So document your key processes, delegate responsibilities, which sometimes means you're going to have to give up a little bit of control, or you're going to have to start like training somebody to be able to make the sort of decisions that you make, which also sometimes means that you have to start thinking about, why do I make these decisions the way that I do? You're going to have to start being able to articulate that and share that with others. And, building a team that can maintain operations, independently of you. So how long could you go on vacation? If you could leave and go on vacation for a month and you would come back and your business would still be operating smoothly, then you probably have this down pat. If you leave for 3 days and the wheels are coming off the bus, you have some work to do on this. But when you do have, your systems and operations working out smoothly, it demonstrates scalability and reduces that perceived risk. And here's something that you can do that is low cost, high impact. But even that prior one, these days, I want to go back and say this. Even like systematizing and like documenting your systems and processes and workflows and things like that, that is easier than ever with AI. So if you're not using AI, you really need to be. And like doing this, the systematizing, all that sort of stuff used to be kind of onerous, but it really isn't anymore. So it even with the help of AI is also in the low cost, high impact category. Okay, next, leverage referrals and testimonials. This is super low cost and super like uber high impact. So encourage your happy customers who you have. If you've been in business long enough that you're considering, like, is it time to sell my business? You have happy customers, right? That you're doing something right. So encourage them to share their experiences and encourage them to refer others. So our strong referral network not only drives growth, but it also shows potential buyers that you have satisfied clients. And those satisfied clients or customers are loyal. And both of those qualities increase buyer confidence. So start asking for those referrals and testimonials and reviews and the whole world of that. And then another thing that you can do is boost your online presence. And this is low cost, high impact. I mean, even if you have to pay somebody, a bit to to fix up your website or to do some social media for you, it's still it's not that expensive and it makes a huge difference. So ensure your website and your social media profiles and your online listings are all up to date and reflect your brand strengths and that you have consistent messaging, consistent branding across all of it. Doesn't mean that it has to have the identical content, but but you do want it to be consistent where people aren't like, oh, well, I see this here and then I see that there, and is I don't understand why is that different? Regularly post content that educates. Like content marketing is great. Um, you know, it inspires people. People like things that connect with people emotionally. Um, that's content that really has, good legs, right? And then if you're in a business that can do this, showcase client success stories. And if you're not in a business that you can do that, like we can't without a client's permission, and then it still has to be made anonymous. There still are ways that you can, with your client's consent. So it really takes a partnership with your clients, which also kind of like ties into the previous slide, right? Being able to ask your happy clients or customers to help you in this way. It's really important to us. It helps us grow, and it helps position us better in the market. So when you have this, it builds credibility and visibility, and on doing your making your online presence strong. If you wanted to, technically, you could do that at very little cost. The next thing you can do is to create a lead magnet and email funnel. And this is also low cost, high impact. It takes a little bit of creativity, but and again, AI can really help with this. So offer a free resource like a checklist or a guide, in exchange for email addresses. And then nurture those leads, with a short email series. Um, or newsletters, things like that. It builds a warm audience and it demonstrates that your business has like a repeatable marketing engine, and it also keeps you top of mind out in the marketplace, and that just builds more and more goodwill and shows more and more value. And of course, when you are preparing to enter into the conversation with potential buyers, you're going to want to be able to explain, like, what is the business's potential? A lot of times buyers are looking for something that's left on the table. So sometimes people think, oh, my business I have to have everything buttoned down. My business has to be perfect. I have to have it all everything perfect and in order and all maximized before I can sell it. And that is a myth, and that is just not true. Um, Buyers, a lot of the time, they are looking for a strong asset that is low risk, but also has the potential for growth. And so you want to be able to leave something on the table. So you're going to need to be able to explain what untapped markets are there for your business that you're not tapping but could be tapped, right? And it's okay that you're not tapping it. You're doing what you're doing, right? So, and explain new product or service opportunities that you see could be put in place you're not doing it, but they could be. Or, if you do have expansion plans that you're putting in motion, be ready to like really explain those expansion plans and what's going to be the outcome of those expansion plans. And that, all of this helps buyers envision like what could be the next chapter for this business. And when buyers look and say the next chapter of this business could be really strong, that increases the value and they pay accordingly. All right, so next we're going to talk about the legal and tax considerations and the documentation that's needed for the sale process. And of course, as a lawyer, this is the part that I'm like, yeah, I'm like really digging on this. That I know that most people, it would make their head explode. And so it is my goal to not explode your head. So we're going to go through it, but at a high level, right? Different types of business sales um, have different legal and tax consequences. And so we're going to just quickly go over some of those ways that you might consider structuring, your sale. But of course, this is the sort of thing that before you do anything, you're going to want to get some advice from a professional. All right, so let's dig in. So the first potential way of selling is an asset sale. So what this is, it's where the buyer purchased specific assets of the business, like equipment or inventory, customer list, intellectual property, all sorts of stuff, but not the legal entity itself. So the seller retains ownership of the legal entity itself and whatever liabilities, aren't transferred. So every now and then there is a liability that gets transferred because it's a liability that's tied to an asset. Think of it like a business. I'm sorry. Think of it like a building has a mortgage. You're gonna in that sort of case, that building is still going to be subject to the mortgage, like that. But otherwise, the other liabilities of the business stay with the seller. And in this sort of thing, contracts and licenses, leases, intellectual property, all of that needs to be reassigned. It needs to be transferred. So each of those individual pieces, it can be time consuming, but it's part of the deal, right? Tax consequences. Sellers might face higher taxes due to depreciation recapture. And I don't want to like go into that, right? Just know that sellers might have higher taxes in an asset sale. But an asset sale benefits buyers because buyers get a step up in the assets basis. So instead of like the whatever cheap amount, something that has appreciated over time, they don't take it at that lower value. They take it at the current fair market value. So an asset sale is great for buyers who want to avoid inheriting liabilities. And, this is great for sellers, businesses that have, valuable, tangible or intangible assets. And I would say that these days, most of the sales that we are doing with people are asset sales. It really is most of the sales that happen, not all, but most. The other, on the other end of the spectrum, is a stock or equity sale, or like if it's an LLC, you might know it as a membership interest sale. So this is where the buyer is purchasing the ownership interest in or the stock itself, in the business entity itself. So the business continues as is. None of the contracts need to assign or change or anything because it's the business, the contracts are with the business and the business is staying the same. Even though the ownership is changing, the business isn't changing. So it's easier as far as that's concerned. So it is a similar, transition for employees and for customers and kind of on the back end. The tax consequences in this kind of sale, the sellers, that typically pay capital gains tax on the sale. So whatever it is that they have as their basis that they put in, initially, and they've grown the business, and that, now it's this sale, they pay capital gains on that difference. And buyers might not get a step up in asset basis, unless special elections are made. And I am not swimming in those waters. So just know that that generally buyers are not getting a step up in basis. So, this type of sale is great for, sellers who are looking for like favorable tax treatment and buyers who are confident in the business's existing liabilities and structure. And a lot of times these sort of transactions are happening where with like where there's already multiple owners, or like there's maybe, let's say there's two business owners, one buying the other out, of course, is going to be this kind of sale. Um, there are some reasons why two people are sometimes this is the best choice. So mergers, or what's also called an F reorganization sale, is a more complex sort of sale. It's where, there's two entities and one is merging into the other, and one entity is going to be the survivor. There are oftentimes larger companies that are doing this, but we've certainly done plenty of closely held companies this way for specific reasons. So this isn't something that is super common, but in the right for the right situation, it's the right thing to do. So, it can help streamline the transfer of assets and liabilities. And a lot of times these sort of things are done in private equity sales, or like, and also multi-entity transactions. On the tax consequences, sometimes it can allow for deferred taxes, or sometimes you can characterize the transaction to reduce the tax burden. And depending on what elections you make, it can preserve as the S corp status while also getting a step up in basis. So that's all of not my world. That's the CPA world, but all that is some of the benefits of mergers. And these are generally for larger, sometimes more complex businesses, or sometimes when we're able to make it where both parties can optimize the tax outcomes. And then installment sales are seller financing. We use that term seller financing a lot. Sometimes the seller financing is tied to an asset sale. Sometimes it's tied to a stock sale. But in general, seller financing is when, the buyer is going to pay the purchase price over time rather than in a lump sum. Sometimes you have buyers who aren't able to get bank financing, and sometimes you have sellers who aren't going to be able to, their business isn't attractive enough to a wide enough swath of potential buyers for them to find a buyer that is going to be that's going to be willing to buy without seller financing. So there's good and bad things with seller financing. On the seller side, the seller has some risk. Like if the buyer defaults, right? If the buyer in a seller financing situation, the seller needs to be doing as much due diligence on the buyer as the buyer is doing on the seller in the business. Because if the buyer buys the business but doesn't have the business chops to keep the business going, and is they're planning on buying, on paying the seller off with the cash flow from the business, but if the buyer is going to crash the business, then one, the seller's not going to get paid, and the remedy is usually that the seller is going to get the business back, but now the seller is getting back a broken business that they're going to have to rebuild. And sellers they're selling business and they're stepping away because they're not wanting to run that business anymore. So it's a double-edged sword, right? Because sometimes you can't sell the business without seller financing, and it is also kind of a risky transaction sometimes. And definitely, if you're going to engage in this, you need to make sure that you have security agreements and promissory notes, and there's you know all the world of that financing. Your own financing documents need to be tied down, buttoned down, tight. Um, the good thing though is that the sellers can, you can spread your capital gains, tax over several years, and that can potentially lower your overall tax rate, and you might be able to get that to work better, in your life. And also sometimes people are like, oh, even if I had a lump sum, I would just park it somewhere. And really what I need is like ongoing cash flow for my own life. And, this sort of arrangement works for some people. And then buy sell agreements, these are really for internal transfers. So what it is, it's an agreement between the co-owners in a business. So it's really, multi-member business, or sometimes like family businesses. And we decide in advance, like how the terms that are going to be for a buyout, and how a business is going to be valued, and under certain conditions like retirement or death or divorce or disability, things like that. The good thing is it provides clarity, it reduces conflict most of the time, not all of the time, but most of the time. And sometimes these sort of buy sell agreements are funded by either a life insurance policy or disability insurance policy that the company owns on the owners. And so there's some, planning that can go in place that can make that whole transaction, work more smoothly and more easily. Um, and a lot of times, you can qualify for good estate tax treatment, and you can build that into the agreement. But you also need to make sure that they're carefully structured to avoid unintended tax consequences. Sometimes people say, "Oh, we want to value the business this way, in our buy sell," and it's like, well, let's take a beat there, because the IRS is going to value it this way, whether you do or don't. So, let's make sure we're not creating a problem for you down the line. So this is best for family businesses, or you know closely held companies with more, like a multi-member LLC or partnerships, things like that. All right. So next, we're going to cover the important documents that are part of a business sale. The first thing is a letter of intent. So this is like a handshake in writing. So a letter of intent says, we're not obligated to finish this deal, but you're agreeing that you're not going to go and consider other suitors, because you've decided that you're going to only consider me as your suitor. So it outlines the basic terms, that the buyer and the seller agree on the front end before diving into the details. So it's not binding, but at the same time, there is this idea that we've looked at it enough to say, this is my offer, and provided everything you've said about your business is true, then my offer stands. So you want to be careful about what you put into the letter of intent. I mean, don't go into it with a cavalier attitude, but at the same time, um, you know, if the business turns out to be not as you imagined, you aren't obligated to complete the transaction. Confidentiality agreements, otherwise known as NDAs, before sharing any sensitive information like your financials or your clients list. Both parties need to sign, this promise that they're not going to share or misuse what they learn, even if the deal doesn't go through. Now, one of the reasons why I think using a business broker is an excellent idea is because they are able to market your business in a confidential way. So it's not like advertising to your competitors and to your vendors and to your customers and even potentially to your employees. Hey, I want to sell my business, right? It keeps that all under wraps until it's time, to appropriately share it. So if you're thinking about selling your business, really that confidentiality aspect, or that being able to market your business with anonymity, is super valuable. And of course, next is the purchase agreement. It's a main contract. It spells out what's being sold, for how much, under what conditions. It includes the payment terms, what assets are included, and what happens if something goes wrong. And it includes oftentimes, even oftentimes includes provisions that survive the closing and continue on into time. So you might have heard this term due diligence. Due diligence is really the buyer's homework. So things like looking at the financial statements, looking at the contracts, looking at the licenses and the permits. What is this? Is this business? Is it in good regulatory standing? Looking at if it has commercial leases and all of that, or if it has commercial real estate, if it has environmental, do we need to do a phase one environmental and things like that. There's a whole list. We have a whole list of due diligence. We're not going to go through the whole list. But the seller provides, the due diligence documents, so that the buyer can verify that the business is what it claims to be. The items of due diligence too are one of the things that survive the closing of the transaction. So due diligence on the seller side also becomes the things that you are more or less stating and testifying, this is true about my business. So it's important that your due diligence be accurate, incomplete, thorough. When you're doing when all the ink is dry, right? The bill of sale, this is the receipt for the transaction. And this is the legal document that shows that the ownership of the business or the assets, if it's an asset sale, has officially changed hands. And then post-sale, right? There's all these contracts that especially in an asset sale, right, where those assets, those contracts that are assets of the business are transferring from the seller to the buyer. There has to be an assignment of those contracts that says, gives everybody notice. All right, this contract, buyer is now party to this contract, stepping in the shoes of seller. That's what an assignment is. So this documents that transfer. And sometimes there can be lots of assignments. And then an asset list, whether it is an asset purchase or a stock purchase, oftentimes there is an asset list. Well, the asset list for sure when it's an asset purchase. Oftentimes with a stock purchase, it can also be to just say, hey, this is what's under the hood. So it's a detailed list of everything that's being sold, equipment and inventory, intellectual property, so there's no confusion later. And then the disclosure schedules. Disclosure schedules are also tied to due diligence, you could say. These are the attachments to the sale agreement that list exceptions or special situations. Things like pending lawsuits, or if there's unusual debts, or customer disputes, or, tax audits, things like that. So those are hey, everybody, we have this going on and this is how we're going to handle it. And then oftentimes business sales come with a non-compete. So you might have heard that Minnesota relatively recently made non-competes illegal, or not illegal like you get thrown in jail, but unenforceable in employment settings. Well, and that's true in employment settings, but that's not true in business sale. Matter of fact, both the legislature and the courts have specifically said, as a matter of public policy, non-competes are continuing to be enforceable in the case of business sales. Otherwise, who would buy a business, right? You wouldn't buy a business if you knew that the seller could go across the street and decide to open up, a competing business and take all their customers. So the non-compete, it outlines what the seller can and can't do after the sale, how long it'll be, and then there's also transition agreements often saying, how long the seller's going to stick around and help train the new owner and the things that they're going to do in order to help make that transaction go smoother. All right. And then there's also when the buyer or the seller are themselves business entities, we need internal documents to show that the owners or the board, approves the sale and has the authority for the sale and things like that. And of course, even when the buyer and the seller are individuals, we there's a corporate resolution to show that within the corporate records that an ownership has changed, right? And sometimes if there's an operating agreement in place, then we have to show, the company officially consenting to this sale. So that's just kind of like the legal, the things that we need to tie up. So next we're going to talk about finding the right buyer. So you can find a buyer, but if it's not the right buyer, is it really going to be helpful to you? Maybe not. So finding the right buyer is kind of critical. So we're going to talk about strategies to help identify and approach potential buyers and, how to evaluate their suitability for your business. So here are some strategies for identifying. One of the things you can do is tap into your professional network. So whoever it is that are your trusted contacts, it could be clients, could be vendors, it could be your advisors, could be peers. Those people who may know the perfect potential buyer or know somebody who might be interested in buying a business like yours or who could make introductions. So the pros, that's like low cost. And if it's coming from a trusted referral, it's high trust, right? And warm introductions often lead to smoother conversations. So, but there are some cons. And one is that it's limited reach, right? Depending on how big your network is, you may not have your network may not be connected to really all the right people. And it may not even bring like the highest value buyers to you. And of course, there is that confidentiality aspect that I had mentioned before. Another way, one that I highly recommend, is engaging with a business broker, or if you are a really large transaction, sometimes an investment banker. So these professionals, they specialize in connecting sellers with qualified buyers. And they also help in preparing your business and managing that sale process. So the pros is that these professionals, they have access to a broad pool of vetted buyers that you on your own would never have any reason to come across. And also they can help with that, valuing your business the right way, marketing it the right way, negotiating it, um, your business sale, you may do one or maybe two in your lifetime, but they're doing them all the time. And so they can make your transaction really work much better than you can alone. And in some ways, the only con that I can see is that, oftentimes they have commission-based fees, which are sometimes like, I don't know, 5-10% of the sale price. But here's my big, big, big bet on this. More often than not, what the difference that a business broker can help you bring in on your business sale more than makes up for their commission. I mean, it makes it like more by an order of magnitude of 2 times or 3 times what their commission is. So, don't be afraid of that commission. Really, they are worth the commission to work with. The results that they get are worth it. And I guess the other con might be that you have less control over how your business is presented, but at the same time, because you have less control, that is a good thing, because they're going to be able to market your business in a way that protects your business in the long run. So there are ways that you can also market your business yourself, confidentially online. There are business platforms, Biz Buy Sell, Axial, DealStream. So there are some that you can use. Um, the pros is that, it is a, broad exposure to buyers. Seriousness, hard to say. You can screen inquiries before revealing details, but it isn't those. I would say one of the cons is that, those potential buyers aren't vetted like they would be with a business broker, right? And here's some of the cons. It requires time to manage those listings and those responses. Consider it like business sale online dating. If you've ever done online dating, it is like its own freaking full-time job. Well, this is the same sort of thing, only instead of looking at, like potentially having a date, you're looking at, potential buyers. And also there is a risk of competitors or employees discovering the listing, especially if you're not very savvy about what you say about your business and how you position it. People can sometimes figure out, oh, I know who this is, or I think I know who this is, and it can be a problem. And then here's another thing that you can do. If you know strategic buyers, companies that are in your industry or companies that are adjacent to your industries people, companies that would are super aligned with your business, that could benefit from acquiring your business. You could, if you know them, you can approach them directly, um, you could look for, like, to the angle of, hey, are you looking to expand your market? Are you looking for, employee talent that knows your business and an adjacent business, right? Or, do I have technology that fits with your technology in your business, right? Things like that. Um, one of the good things, pros, like one of the good things is that strategic buyers are often willing to pay a premium for a good strategic fit, and they may already understand your business model. But some real cons is that it can be awkward and risky if they're competitors. And that initial dance of requiring NDAs and careful messaging, it can be fraught. So there are some definite cons there. And then another one that we see a lot is to consider internal buyers. So, and that can be employees, could be partners, can be family members. Sometimes the best buyer is already inside your business. Key employees, might be interested in taking over. A lot of times in certain businesses, we like to at least have certain key employees be made an offer in times when they've worked the business many years, they've expressed interest in potentially owning the business at some point, or being able to take over for the owner at some point. If they don't have a crack at the apple, then sometimes there's bitterness there, and that can have things slide sideways. And then sometimes there are insiders who are the perfect buyers, right? So here are some of the pros. you know Smooth transition, super smooth with minimal disruption, and it definitely preserves company culture and the client relationships and all the things that people fear might change about the business. Generally minimal of that. But here's some of the cons of having an insider is that, sometimes your employee, they've been a W-2 employee all their lives. They may lack the financing it takes to be able to buy out, the owner, and or sometimes they don't have like really the ownership experience. Like being a business owner is very different than being an employee. Um, it's a completely different sort of world. And it also, here's another con, it can complicate relationships if the deal doesn't go through. So here is something that I think is a very clever way, and that is to host an educational event or a workshop. It could be a webinar, it could be in person. Instead of focusing on an educational event that focuses on potential clients, instead, it focuses on connections within the industry And so it's an educational thing that positions the business owner as a knowledgeable leader in their industry. And I don't know, it could be on something like the trends or the challenges or whatever in your industry, or succession planning in your industry. And it attracts the attendees who are already interested in the space of your businesses, right? Not as customers, but because they're industry partners, you could say. And so those people might be potential buyers, and or they could be even potential buyers who haven't been actively looking, but might be intrigued by your business, right? And so it's a way to like increase the number of contacts that you have that you might be able to connect with. So it builds credibility and trust with your potential buyers. It attracts people who are like value aligned to you or your company, and it also can generate leads beyond just a potential buyer. It could be, you could meet somebody who might be a good business partner for you if you want to sell half your business instead of the whole business, or investors, things like that. All right, but here are some cons. It does take time and effort to plan and promote, and to reach those people. It may not yield immediate like buyer interest. Um, so really, for this to work, you need to have a follow-up strategy. But it is I would say, a subtle and smart way to attract what might be potential buyers without putting up a for sale sign. So it's really, about creating those connections and cultivating those connections and those relationships and seeing where they go. And potentially you might meet somebody who could become a position of a buyer. Okay, next we're going to talk about negotiation tips and closing the deal. So negotiation is an art. And there are some things that you can do that make it better than not. So the first one is knowing your value before you open the door to negotiation. If you know what your business is worth, it helps you like like price it right in the marketplace, and it also helps you avoid underselling. It helps you set up realistic expectations, and it strengthens your confidence. And yes, it may require some time and cost to obtain a formal valuation, but it will be worth it. The next negotiation tip is to build rapport with the buyer. So when you have a good and non-adversarial relationship with the buyer, that is better. This is like, you don't, as an attorney, I don't want to put on a litigation hat in and having a relationship in one of these transactions. That isn't going to be helpful or fruitful. Having a certain amount of affinity and trust goes a very long way in having these deals get done. And in almost every deal, there's some point where somebody needs to be talked off the ledge. And if you're in an already a friendly and high affinity sort of relationship, it's easier to do that talking off the ledge and having things move forward than when you don't have that rapport. So encourages goodwill and flexibility, reduces friction, but the con is that it could blur boundaries if you're not keeping a certain amount of professionalism in mind. Do you remember that you're not trying to make them your very next best friend? They might become so, but not during this transaction. All right, so lead with a strong, clear offer. So confidentially, but present your terms clearly. What you want for the price, what you want for a payment structure, what you're willing to offer for transition support, all that sort of stuff. Remember, you're the seller. You get to say initially what terms you want to sell your business for. Don't say, here's my business. Well, what do you want to offer me? That is not the way. So when you have these clear, strong terms that you know in advance what you want, it positions you as prepared and serious, and has them get serious. No, but I don't want you to get so stuck in your clear terms that you lack flexibility, right? So I also want you to stay flexible, but know your walkaway point. So you're going to need to be open to compromise on non-essential terms, but you need to also define your deal breakers in advance. So when you can be willing to be flexible, it really increases your chances of closing the deal. Of course, without your clear limits, if you don't know your boundaries, you risk conceding too much. So it's a balance. It's a balance of being flexible and knowing what it is that we're not to give. All right, so this is a tip that I use all the time, attorneys use all the time, and that is to use silence strategically. I don't know if you've noticed this. Sometimes you'll be in a conversation with somebody who they always have to fill the space. They're like really uncomfortable with silence. Well, if you can train yourself to be comfortable with the silence and just sit there and let people be for a moment, if you can use that silence strategically, sometimes the other side will just because they're so they'll just blah 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 to fill the gap because they're uncomfortable with the silence. And oftentimes they fill that gap with concessions, or that's where you'll find out the thing that they weren't going to tell you, right? Things like that. It gives you leverage without you having to say a word. And the cons is that if you're not used to it, it can feel uncomfortable. Sometimes it takes practice to get comfortable with that silence, but it is a very powerful tool. The next thing is negotiate on more than just the price. So yeah, the price is an important term, but there's, other things like the payment schedule. Are you going to do, lump sum versus, seller financing? How long are you willing to include transition support? And what does that transition support include? Negotiate your non-compete clause. you know, negotiate if you're going to do something affirmatively to help with the retention of the key employees. When you're willing to negotiate more than just the price, it creates more room for those win-win outcomes. The more win-win outcomes you have, the more likely your deal is going to cross that finish line. And it does, but the con is that it can add complexity to the negotiation and to your deal, but at the same time, it's worth it, right? Being able to tailor the deal that fits on both sides is, you know, it's what people are looking for. So the last thing on this section, bring in a professional negotiator or advisor. So an attorney or a business broker can really help you navigate the complex terms. And they can also, because they're an outsider to it, can help keep emotions in check. Sometimes having that that bit of emotional distance can really help. Um, you know, Professionals add expertise and objectivity. Of course, the con is that it involves additional costs, but again, that additional cost is generally worth it. There are some things that are worth it to get the advice on. Okay, and of course, my webinar would not be complete if I didn't give you the final steps to close the deal successfully. So when it comes down to it, you're going to review and sign the final agreements, and you're going to make sure that all the documents reflect what was negotiating, everything. Everything must be in the four corners of that document, or it's not part of your deal. So if you think, oh, well, they said this, nope, if it's not in your contract, it's not part of your deal. So we're looking at the purchase agreement, the non-compete, and your transition agreements, the assignments, the final asset list, the disclosure schedules, all of that. And this is, even if you weren't planning on having an attorney through the whole process, at least before you get, to the signing signing the document in ink, have an attorney look at everything first to make sure that your understanding of the deal is what's reflected in the document. Because as soon as you sign it, it's real. There's no going back. That is the legal moment when you cannot, there's no turning back. And then confirm the funds are there, and then, finalize the payment. So a lot of times these transactions are involve an escrow account, but sometimes not. Sometimes it's, one person shows up at the closing table with a check, and the other person is, like, here's my bill of sale, and that happens. So you want to make sure that the payment is good. um, and if the payment is, on a installment sale, seller financing, make sure that you have the signed promissory note, and you have, the collateral agreement in place, things like that. And then um, transfer ownership and operational control. So there's a coordinated handoff that needs to happen. Business licenses, bank accounts, vendor relationships, keys, passwords, access credentials, introduction to the employees and to the clients and vendors and the whole world of that. So that having that be coordinated makes a huge difference. And a smooth transition protects the business's momentum, and it also protects your reputation. And next is notifying the people who need to be notified thoughtfully. So once the deal is signed and the funds are confirmed, there is a better way than not to notify employees and clients and vendors, in an appropriate way. So consider co-authoring a message with the buyer to ensure you have a unified tone and a smooth handoff, and to make it the best it can be. And then document the transition. So you're going to wrap up with a closing memo or a summary email that outlines what was transferred, when and to whom, and whatever remaining support is lined up, whatever your transition support agreement or plan, your understanding of that is. And, it creates a clear record and sets expectations for both you and the buyer moving forward. And then the most important part of all, celebrate. Like, take a moment to acknowledge the milestone, whether you're having just like a quiet, toast at home, or like, thank you note to your team. Like, closing a business sale is a big deal. You should know it's a big deal. Not everybody makes it across the finish line. And if you do, kudos to you. And yeah, that's what it's all about, right? Okay, so what's next? If you're ready to maybe take a deeper dive into learning about how to prepare yourself and your business for a potential sale, I invite you to come to the Sell Well Summit. So this is a one-day workshop that greatly expands on what we've talked about today. And you can go to sellwellsummit.com to learn more, or use the QR code. And I'd be delighted to see you there. And if you think you may be ready, like right now, ready to sell your business, reach out, and I'll be happy to have a complimentary discovery call to see how I could help you, um, and to see, who I can connect you with to get your sale team put together. It does take a good team, of people to make sure that you're getting, oh, there is my time, to make sure that you get everyone that you need put together. And if you're not ready to sell, but you want to talk to me about something else, I would also be delighted to visit with you about whatever's on your mind. So there, you can reach out to me. There's my QR code for contact. I'll stick around and answer questions if anybody has any. Um, and otherwise, we've come to the end of our time. Thank you for your time and attention today. I wish you all the best in your business endeavors, and, don't be strangers. Feel free to reach out. I'll be sending out the recording, and of course the bonus materials that I put together. So thank you, everybody. All right, I'm not seeing anybody in the chat or the Q&A. I'll stick around for just a few more minutes. All right. Thanks, everybody. Have a great rest of your day.